Welcome back to the channel. Today, we're diving deep into one of the most important topics in real estate: how to invest successfully even when interest rates are high. Whether you're new to real estate or you've been investing for years, the market we're in today is unlike anything we've seen in over a decade. But here's the truth. High rates don't eliminate opportunity, they shift it. In this full-length guide, you'll learn everything you need to know to make smart, profitable moves in a high-rate environment. Let's get started. Understanding the reality of a high-rate market. To start, we need to understand what a high-rate market really means. Many investors get scared the moment mortgage rates rise. But the truth is, interest rates are only one part of the real estate equation, and when everyone else is scared, that's when opportunities open up. In most economic cycles, real estate markets balance between affordability, demand, and investor sentiment. But when interest rates spike, monthly payments increase, buyer demand softens, inventory rises, sellers become more motivated, investors gain leverage. This environment makes properties sit longer on the market, which can be a massive advantage for prepared investors. You often hear new investors say, "High rates make investing impossible." But professional investors say the opposite. High rates create opportunities beginners can't see. Why? Because fewer buyers means less competition, better negotiation power, more seller concessions, more creative financing options, lower risk of bidding wars, more time to analyze deals properly. High rates don't stop real estate investing. They change its strategy. Why high rates can actually benefit savvy investors. You might be wondering, how can a tough borrowing environment actually benefit me as an investor? Well, the advantages are more significant than most people realize. 1. Less competition equals more opportunities. When rates rise, unprepared buyers exit the market, emotional buyers disappear, and overly aggressive investors slow down. This leaves motivated sellers and undervalued listings for those still willing to play the game. 2. Prices correct themselves. In high-rate cycles, home prices typically adjust downward, not always dramatically, but enough to create room for deals. Properties might sit 30, 60, or even 90 days. This gives investors something priceless. Time to negotiate, time to analyze, time to inspect, time to find mistakes in pricing. 3. Better terms and seller incentives. Sellers in high-rate markets offer incentives like closing cost credits, rate buy-downs, repairs and upgrades, flexible timelines, seller financing. These incentives can dramatically lower your entry cost. 4. The market will not stay high. Forever, rates rise and eventually fall. When they fall, property values typically rise, especially rentals. This creates an enormous opportunity. Buy when rates are high, refinance when rates drop. Enjoy increased equity and cash flow. Professional investors live by this principle. How to analyze deals in a high-rate market. Now let's get into the practical side. How do you analyze a deal when mortgage rates are 7%, 8%, or even higher? Traditional rules still apply, but you must adjust your underwriting standards. 1. Cash flow requirements must be stricter. In a low-rate market, borderline deals may break even or slightly cash flow. In a high-rate market, there is no room for mediocre returns. Aim for higher cash-on-cash returns, more conservative assumptions, larger reserves. Your margin of error needs to be larger. 2. Use updated mortgage calculators. Many investors still analyze deals using outdated assumptions. When rates rise, your payment increases, sometimes dramatically. Always recalculate monthly mortgage, debt service coverage, cash flow, long-term refinancing potential. 3. Rent growth matters more than ever. Properties in areas with strong rental demand tend to thrive even when interest costs are high. Look for job growth, high population growth, low vacancy markets, universities or hospitals nearby, areas with limited new construction. These conditions can cushion you against rate-related cash flow challenges. 4. The refi eventuality strategy. Smart investors buy with today's numbers, but plan for tomorrow's refinance. This means expect tighter cash flow now. Prepare for expansion later. Lock properties at today's lower prices. Refinance at lower rates in the future. Capture both equity growth and increased monthly cash flow. This strategy has made countless investors wealthy. Negotiation tactics that work in a high-rate market. One of the biggest superpowers you gain in a high-rate market is negotiation leverage. When sellers feel pressure, they are more willing to accept terms that benefit you. Tactic 1. Ask for seller rate buy-downs. Sellers may pay to lower your interest rate. Even a 1% buy-down can save you thousands annually. Tactic 2. Ask for closing cost credits. In many markets, it's completely normal to ask for 3%, 4%, sometimes even 6% in concessions. This reduces your upfront costs dramatically. Tactic 3. Negotiate inspection. Findings aggressively. Since homes sit longer, sellers are more willing to fix roof issues, HVAC problems, plumbing defects, electrical issues, or they may reduce the price accordingly. Tactic 4. Control the timeline. In a fast market, buyers have no power. In a slower, high-rate market, you control the pace. You can extend due diligence. Request longer financing periods. Set flexible closing dates. This gives you more time to secure ideal funding. Tactic 5. Make data your weapon. Use historical price trends, days on market, comparable sales, inventory reports, pending sales data. Sellers respond to facts, not feelings. Creative financing, the secret weapon of high-rate investors. Now this is where high-rate investing gets exciting. When traditional financing becomes expensive, alternative financing becomes powerful. 1. Seller financing. This is exploding in popularity. Why? Because sellers become more flexible. Benefits include lower interest rates, low down payments, faster closings, no bank qualification, fewer fees. If a seller owns a property free and clear, this is an incredible opportunity. 2. Subject to financing. This is when you buy a property subject to the seller's existing mortgage, often with a much lower rate. Example: seller has a 3.2% mortgage. You take over payments. Mortgage. You take over payments. You avoid today's 7-8% rates. This strategy is extremely powerful. 3. Lease options or rent-to-own structures. You control real estate without immediately owning it. This allows you to benefit from appreciation, rent credits, lower upfront cost. 4. Hard money plus refi later strategy. For flips or brrr deals, this is common. You use hard money now and refinance later when rates decrease. 5. Partnerships and equity splits. In a high-rate world, risk sharing becomes more common. You can partner with capital partners, contractors, property managers, experienced investors. You bring value. They bring money or expertise. That wraps up part 1 of this full-length masterclass on real estate investing in a high-rate market. So far, you've learned the mindset, market shifts, analysis rules, negotiation tactics, and creative financing strategies that give investors a massive edge even when borrowing costs rise. In part 2, we'll go deeper into rental strategies, cash flow systems, tax advantages, market predictions, and advanced deal structuring techniques. You don't want to miss it.